a student of mine, Eben, asked me if I could go through the divergence technique. There are two kinds of divergence techniques. There's a divergence technique whereby you compare an index or a stock with its underlying oscillator. So for example, you may have an index like the Dow Jones index, and underneath it you will have stochastics or RSI or MACD, and divergence would be an example of where the stochastics is making a double top or even a higher top, whilst on the underlying index it makes a lower top. That's what's called divergence. However, divergence can also be used when you compare two products next to each other. So just as a very right here, right now example, this top that we are seeing here in the Dow Jones index to the left. One to the left is the Dow. Put that here. And over here, have the DAX. And these are the two that I often compare or trade against each other. So right here, right now, I have an index right here, which would correspond to this top here. So what you should be able to see is that whenever I move the cursor from one to the other, you'll see that it follows on the other chart. So if I'm making a like-for-like comparison, and I put some numbers on, let me put some letters on instead, because I've been using numbers. Then it means that the point X and point Y on each chart will correspond with each other. So over here in the Dow, I've got a Dow that has just made a higher high, whilst over here in the DAX, I have an index that has made a lower high. And whilst I haven't got I could use this as a sell short signal. What I've done instead is, because I've been trading on the long side all day in the DAX since this morning. It's been a long day. It may not look like a lot to you, but this sideways here spanned for nearly 3 hours before we finally broke through. And I've been sitting patiently waiting through this. What that has meant to me, what I'm seeing up here, is that I've stopped adding to my long positions in the DAX, and right now I'm just waiting. And I thought that it would be a good time to explain how I use the index divergence when I'm trading. Sometimes it will result in trading signals. Other times it will just result in a kind of a guidance. So what I'll do is I'll create a red arrow over here, make it a little thicker, and then you know what it is that I'm looking at. I'll do the same over here. Arrow, make it a little thicker, and voila, we now got a pointer. Okay, so point 1 on the Dow chart will correspond to the point 1 on the DAX chart. And what I'm doing here is I'm only comparing today. I am not even looking backwards in time, which is a real possibility when you're trading, that you can look backwards. But here I'm just looking at right here, right now for this day. Both indices trade a little lower into point 2 and into point 2. This point here, along the way up to point 3, this point here, it hasn't been marked with a number, but the arrows are pointing to it, and the cursor, the crosshair of the cursor, is pointing to it right now. At this point here, the Dow is making a lower high compared to the DAX that has just made a higher high. What you should be able to notice is that on the DAX side of the charts, the DAX trades sideways to lower for approximately 10 minutes. It may not look like a lot to you. It probably isn't a lot, but DAX over here has a high of 88 and a low of 64. So it may not look like a lot on a big day, but the DAX actually does trade down approximately 24 points. The Dow itself, sorry, the DAX trades down by 24 points. The Dow itself doesn't do that much. This morning I was aware of this divergence, but and I use the word carefully here, I was hoping that this sell signal that I got here wouldn't conflict with my buy signal, meaning I simply had to sit through a correction. If I hadn't already been in a position, would I have taken a short signal because the Dow has made a lower high, but the DAX has made a higher high? And the theory goes that when one index makes a lower high and its corresponding correlated index makes a higher high, the index that has made a higher high will be unable to continue higher until the other index has caught up. And what we're seeing here is that, well, whether it's a double top or whatever it may be, the DAX trades back down again. Not by a lot, but it trades down a little bit. Then both indices carries on up. And what I should say here is that by comparing one with the other, it gives me a very good understanding of what index is in charge and what index is lacking. This is not a bad idea to keep a track on if you have screens enough and you've got concentration enough for, because it will give you early clues to when one index is running out of steam. At point 3, both indices are making higher highs. When both indices are making higher highs, there's really nothing for me to do. It's just business as usual. Then both indices trades down to point 4. Point 4 is higher than point 2 on both indices, even though in the DAX it's very marginally. Imagine for the sake of the argument that point 4 was lower than point 2 on the DAX chart. Let's say it was down here. What would that mean for me that I could observe that the DAX has made a lower high, sorry, a lower low, but the Dow had made a higher low? What that would mean for me is that it would set up a potential buy signal. And in here, I think, is where some of the confusion lies. One second. You see, the question that I could imagine would be on your mind is, all right, I'm not blind, Tom. I can see this phenomenon of the market making higher highs together or lower highs together, but I can also see when one is making a higher high and the other one is making a lower high. But when do I actually buy, or when do I sell? And the answer to that actually lies in the structure of the price action itself. So for example, if I could see a higher low here in the Dow, but a lower low here in the DAX, which one would I be interested in buying? Well, there's some theoretical arguments that says that, yeah, well, you could buy the one that has just made a lower low, because if it really is going to follow the other index, then it will catch up as well. However, normally I prefer to always buy strength and I prefer to sell weakness. So if I observe that one index is making a lower high and the other index is making a higher high, which index would you prefer to sell short? The one that has strength or the one that has weakness? For me, the answer will always be that I prefer to sell the index that has weakness, and I prefer to buy the index that has strength. So that's the theory behind it. But then to answer the question here in much more detail, when do you actually buy or when do you sell? If we take a look at point 5, in point 5, you're very clearly seeing that the DAX, despite having a good day, is making a lower high. Can you see that? It makes a lower high, whilst the Dow is making a higher high. At what point does the Dow actually make a higher high? That's what it's doing right here. And the next bar, it is also making a higher high. So we got 5 minutes that passes where the Dow makes a higher high, 10 minutes that passes where the Dow makes a higher high, 15 minutes passes where the Dow makes a higher high, but the DAX is failing to get anywhere near its higher high at point 3. So when do you actually sell? And there's two ways that you can deal with this. The first one is that you actually sell the moment it makes a higher high. So the moment that you can observe that one index makes a higher high and the other one is not making a higher high, you can sell the index that is weak. You could also attempt to sell the index that is strong. The problem with that trading idea is that you need a stop loss, and it can be very difficult to place a stop loss on a chart that doesn't have any natural place to put a stop loss. And so, for example, if you sold here where this red bar indicates that with this blue bar right here, let's say you sold short here, where would your stop loss be? Would it be up here? Would it be up here? Um, Naturally, we always want to place our stop losses above an old high or below an old low, which means if you were going to sell here, you would need a more arbitrary stop loss, such as a 10-point stop loss or a 20-point stop loss. And that could certainly work. But there is another idea which may work a little better. For example, what you're observing here is a 5-minute chart. But what if the moment you can observe that the market is making a higher high on a 5-minute chart, but you're making a lower high on a 5-minute chart in the DAX, what would happen if you swapped over and you zoomed in on a 1-minute chart or a 2-minute chart? And the moment that you observed any kind of weakness, any kind of um, a red bar, you would have a trading idea, because you could see, well, the moment this 1-minute bar closes, I could place my stop loss above it, maybe 5 points above it, or whatever suited my risk profile. You see, where the advantage of this trading technique comes in, it is very, very good at spotting when there's weakness in one market over another market. Its flaw is that it's very difficult to actually place the trade. So for example, uh, the top here in the DAX is 78 and the low here 10 minutes later, 15 minutes later is 53. So again, you're talking about a 25 point correction in the DAX. And while I tell you that many traders will be happy with a 10 or 15 point uh, uh, trade in the DAX, but the challenge definitely lies in placing the stop loss. So if I, instead of looking at point for number 5 on a 5-minute chart, imagine I zoomed in on a 1-minute chart instead, and I went over to point 5 at 10:58. What you're seeing here is that this is point 5, and the moment you see a red bar, which is what you do here, you have an opportunity to place a stop loss above the most recent high, which would be here. Yeah, it's a risky trade, but then so are all trades. And if you use a stop loss and you use it sensibly, then it will provide you with an opportunity to take advantage of these signals. Um, if I go back and I did the same with point number 3. With point number 3, uh, we can see here, not point number 3. Let me just give this a name. Let's call it point number X. Okay. And point number X is here where the DAX is making a new high. If I zoom in on a 1-minute chart, on the Dow, because it was the Dow that had the weakness, then when we begin to observe the DAX making a new high, this was roughly be right here at 0840, where you have a negative bar. As you can well see, this trade signal didn't generate a lot. But nevertheless, it's a good idea to wait for weakness in the market and then sell. The problem here is this, and this is not a minor problem. At this time of the day, it's 0840 in UK and it will be 0940 on the continent. The spread in the Dow will be significantly wider than it is during its normal trading hours, which is at 2:30 till 9 p.m. on the UK and 3:30 till 10 on the continent. So the problem here is that if you get a sell signal in the Dow or buy signal in the Dow before the real Dow Jones index opens, you have to be prepared to use a wider stop because you will have a wider spread. Okay. If we then move on in the structure of the trading day, the next point that we have is point 5. Sorry, we covered point 5. Next point we have is point 6. At point 6, we can see that point 6 is higher than point 4, and the same applies on the DAX chart. Point 4 is lower than point 6. We then move upwards very gracefully, very quickly, and both indices makes new highs. What then appears after point 7 is a long and sideways and very tedious trading environment where no one is really interested in buying or selling anything. Would I trade this with great care? And I would definitely not take any signals that comes because the US market opens. The US market on this chart opens at 2:30, which is point 8. As you can see here, point 8 and point 9 are higher on the Dow chart, but are lower on the DAX chart. The thing here is that you have a very spiky price action in the first 15-20 minutes of the Dow open. And as a rule, I tend to ignore many of the signals that I have in that time frame between 2:30 and 3 o'clock because they are very unreliable. It feels to me as if there's a lot of back and forth. And when you observe for point 8 to point 9, what you're seeing is that the market goes up, goes down, goes up, goes down, goes up, goes down, goes up, goes down, goes up, down, up. And actually, you don't really have that much direction. Now, with experience, you quickly learn to stay aside in environments like that, and then you wait for something like this to happen instead. Here, those of you who attended my 2-day seminar will see this as a great fishing technique set up right here. But otherwise, that's where we are right now. And so we're going back to present time. What we're seeing right now is that the market is just stalling in its bull run higher. And the first warning sign I had of this was that the DAX was making a lower high whilst the Dow was making a higher high. At this point, I will pay attention to it because we are out in the throes of the US Open. And well, actually the reality is that at this point, the DAX has closed for the cash market, but now the futures market is open. I've illustrated this on a charting package called eSignal, but actually you can do the same on whatever charting package that you use, whatever broker. So those of you who uses ETX, you will be able to do this. If I go to the previous day, I want to show you a couple of examples here as well. Where did the arrow go? Okay, so this blue line to the left on the Dow chart and this blue line here to the right, to the left on the right chart, they represent the open in the DAX yesterday morning. And what was interesting here is that quite soon after the open, both market rallied very strongly, and they did that very much in tandem. However, if you notice this point here, lines up with this point here. Notice how the Dow at this point here corresponds with this long bar here. So at this point here, the DAX is making a breakout of its morning range. Whilst the Dow is still in a sideways range. How do I deal with that? Well, the answer is that with some great difficulty. First of all, because I'm inclined not to go against the DAX when it's having a very strong day. I simply just unadvisable to try and short the DAX on a day when it's motoring up the page. So do I consider this a sell signal? Well, it's all about perspective. Do I want to sell a market which is moving higher and higher and higher? Uh, Here the DAX just makes a 30-point move higher. And those of you who've been on my seminar will also know that I'm very fond on what's called extended bars, especially extended bars that comes out of a trading range. So the answer is no, I'm not a fan of wanting to take a sell signal here. But what that would mean is that if I did anything, I would want to sell the Dow right here. If I really wanted to take a sell signal, uh, I would probably get away with it as well. It doesn't do anything for the next half an hour before it too finally breaks higher. So I'm not portraying this technique as a technique that always works, because it certainly doesn't. But it does give you some tremendous guidance of what's strong and what's weak in the market. A little bit later on in the morning, the Dow makes a new high, as does the DAX. Both retraces. And again, the DAX motors up the page and makes a new high, but the Dow is not following suit. If I'd taken this signal here, let's say for the sake of the argument that I had zoomed in on this point here on a 1-minute chart, Would I have lost on this? Very unlikely. Very, very unlikely. The Dow just drifts slower and slowly down into its open before it too catches a bit higher. At the at this point here, if we compare the top formations, see, not all top formations are just one bar. What you're seeing here is that the DAX makes a high, goes down a little bit, and then comes back up again to make an attempt of a new high. That would correspond to this point here. So what I would love for you to take away from this education is that the divergence techniques enables you to catch many a highs and many a lows. And when you are wrong on the direction of the market, or when you are stopped out, you're quite frequently stopped out with minuscule stops compared to what you're going to get out of it. For example, uh, and I know it's a theoretical example, so please forgive me, but were you to have sold the DAX at 10,400, you would have had a potential 60 points from top to low. You would never have caught 60 points naturally. That's not what I'm saying. But hopefully you would have caught perhaps a third of those points, or even 20% of those points. Your risk, though, would have been very, very minuscule, because at this retest here, you could have said to yourself, I'm going to short the DAX here at 10,404. The high is 10,408. I'm going to use a 10-point stop loss. Okay. Um, I have taught this technique to a number of people now, and I think the most common criticism that I get is, why is one index so dependent on another index? Uh, and why is it that because one makes a higher high, but the other one makes a lower high, why does that constitute a sell signal? So if I'm going to address the first question, why are the indices so dependent on each other? And the answer is that the way that the stock market tends to unfold in Europe and then later in the US is that when we come to work in Europe in the morning, what's the first thing that we look at? Well, we say, well, what happened in the Dow yesterday? Oh, the Dow had a good day. Uh, well, that's good. We may have a good day here. Well, let's just see what's going on in Asia. Okay, Asia is having a good day as well. So if America had a good day and Asia had a good day, I think I want to put in some bids for buying the market. Conversely, when we come to work in the morning and the Dow has lost 200 points the night before, and the Nikkei and the Hang Seng is down 2%, do you think that you would be queuing up to buy? Unlikely. You would much more be inclined to look at any sell signals in the market. And so I think that American traders will come to work around noontime Central Time, and they'll be looking at, well, what's going on in Europe? Do we want to sell off ourselves, or do we want to bid it up? So I don't think that it is so unlikely that that when one that two indices that represents the two global hothouse economies, one being the DAX in Europe and one being the Dow in the US, I don't think it's so implausible that those two should uh, move in conjunction with each other. Um, but there are, of course, some points where you have to potentially stay clear, and that is when the Dow Jones opens. So here at point 3, this point here, just before point 3, is where the Dow opens. And when the Dow opens, you tend to see moves that may actually not be the best signals to trade. Often because the Dow can be a real wild beast to trade just at the open. But otherwise, with the benefit of hindsight, what we are observing here is an index that on this bar here makes a higher high. Point 3 is above point 1 on the Dow chart, but point 3 is below point 2 on the DAX chart. And if I were to zoom in at this point here, but I did it on a 1-minute chart at point 3, let me just move this a little closer here. And I go back to the previous day. Excuse me, it's going to take a little scrolling. Then it would be the moment that I observe weakness. This is probably the bar that we are talking about. But whether you sell this bar here or perhaps you're selling this bar here, as long as you can justify it with a stop loss, you will often find yourself in great positions. I don't know how much you're going to risk here, but let's say for the sake of the argument that you had got a really crap fill. So you got it filled at 80. And that means you would probably have to have a stop loss above this one here. So you'd have to have a stop loss at 95. So let's say you're risking 15 points. How low does it actually go? Well, it goes all the way down to 55. So at your crappiest entry to the most opportune exit is 25 points. You would probably never have gotten out. But let's say, for the sake of the argument, that you did sell short here. And you had a stop loss up here. Well, my guess is that you would relatively quickly attempt to move your stop loss down as the market goes lower. Maybe you moved it down so quickly and that you got clipped here. That's a possibility, and then you just have to congratulate yourself for saying, well, I may have gotten out for nothing, but at least my money management is fine. Alternatively, maybe you are lucky and you are writing this down. It's all about attempting to manage your positions to the best of your ability. And just remember that the longer you can stay in this game and the longer that you can learn from your mistakes and learn from your successes, but how could you make your successes better and more profitable, the better your survival rate. It's no point in getting angry just because the market doesn't do what you want it to do. There's no point in saying, "Oh, I wish I'd made more." Yeah, of course, we all wish that we had made more. We all wanted to have that maximum boatload when the market goes parabolical up and we're long. However, less will do, and it is much more important that we talk about survival of the market and prosper slowly and gradually and stay in the game than we want to have a 1 or 2 blow up trades. Okay. Uh, One perspective of this technique, if we sort of look at the previous day, is that when the market is very strongly trending, and that's exactly what we've seen in both the DAX and the Dow. I think I scrolled too far. When you have very, very strongly trending market, um, you tend to um, you tend to get very, very long bars. And when you observe these long bars, as you, for example, do here in the DAX, I'm very reluctant to want to go against the direction of these long bars. So therefore, for example, on something like this, if I observed thank God here, I only seem to observe, I got a higher high here, higher high, higher high, and higher high. Then the market corrects, go up, both makes higher highs, corrects, and both make higher highs. Do you see? Um, when you see this, you should really attempt to follow the trend rather than trying to go against the trend. I don't know if you guys can actually see this here, but it's such a minor signal, but it's something that I observe quite a lot. Can you see that? It's uh, it's the kind of thing that I pay very, very much attention to if I am already in a position. I better explain it to you in case you're missing it. But just back to the lesson, when the market is strongly trending, and you see that on these long extended bars, um, when you see these long bars, I tend to stay well clear of attempting to catch a short. But when the market at one point or another is beginning to run out of steam, one of the earliest indications, the tiniest of indications, is that one of them makes a lower high, whilst the other one is making a higher high, which you're seeing up here. See that right there. So um, I think that's me done explaining divergence. I hope that answered your question, all of you. Uh, I hope it helped getting an understanding of the market. If you have any questions,